Let's talk now about secondary markets. So we've moved from IPOs, the primary market, into the secondary market. So once I've purchased shares, what happens? Let's say that I want to get rid of those shares and turn them in for a capital gain, or I want to trade them in and buy some different shares. How do I do that? Well, that's where organized exchanges come into play. And so the secondary market is a market where securities are traded after they've been issued. So what's the roles of the secondary market? We've really already talked about this, but it's liquidity and then continuous pricing. This is really, really important. And this is at the center of why we have one of the most established markets in the world, is we have the availability of exchanges that allow us to buy and sell securities rapidly. So these security exchanges are just a forum where we can meet together buyers and sellers. Otherwise, what happens? So let's say I want to sell my shares of Walmart. I've got to go out and find somebody to do so. We live in a world today where that has become easier and easier with all sorts of products. Let's say you have an armoire at your house that you want to get rid of. How do you sell it, or a dresser? Well, you can just start asking around, knocking on doors, or you could have a garage sale, or we can have an online organized exchange, such as eBay, or there's several other national sellers out there where I can list items that I want to sell in an easy manner, where there's a market that helps me to find a buyer. Or the other way around. Let's say I want to purchase a particular painting or some other type of collectible. I can go and I can search it on several of these online websites that provide a market for me to do so. Well, that's what securities exchanges do. They bring together these buyers and sellers to create liquidity or continuous pricing in securities. NASDAQ is a unique form of these markets because it's hasn't been around a very long time as compared to some of the older markets, but it allows for electronic trading. That's very unique. It allows us to buy and sell securities over the internet electronically, so I don't have to go and ship anything out. I don't have to go and find a specialist or a person who's going to buy and sell as a representative for me on the exchange. It's all done electronically to connect a buyer and a seller. So let's talk a little bit about these broker markets and these dealer markets. A broker market, probably the most recognizable broker market, is the New York Stock Exchange. When you think of stock exchange, probably one of the first things that comes to mind is a bunch of people yelling and screaming on a floor and giving gang signs to each other to buy and sell securities. Well, that's the New York Stock Exchange. And what's happening with those hand signals and the yelling that goes on in the trading floor is you have buyers and sellers who are connecting with each other to efficiently, it doesn't look efficient, but efficiently buy and sell securities. So in the United States, about 60% of all volume of shares traded runs through these brokerage markets. These are at both the national level and regional level. You don't hear much about regional securities exchanges. You may have traded on one and didn't even realize it, but you have exchanges buying and selling securities regionally, and then you have the big national exchanges as well. So these trades are executed when these buyers and sellers are being put together by what's called a specialist. So on the New York Stock Exchange, you have a specialist on each one of these securities. And that specialist, what they'll do is help connect a buyer and connect a seller, but they also help keep liquidity going in the market. So if there isn't a buyer at any one time, or there isn't a seller at any one time, the specialist will go in and make liquidity in the market by buying or selling shares to facilitate those trades. A dealer market, on the other hand, an example of a dealer market, or probably the most famous one, is the NASDAQ. That's the electronically traded securities market that I talked about earlier. So now you're executing a trade with a dealer. This is a middleman who operates between the seller and the buyer. So the seller sells to the market maker at a price, and then that market maker offers the securities to the buyer. In a sense, the big difference between those two is dealer markets have an added layer. A broker market tends to be more direct, so it's person to person or institution to institution, whereas a dealer market operates more with a person in the middle who's buying and selling. In the end, these two really aren't that different. They sound different, but they're really just exchanges in which I can go out and buy and sell securities. You can see listed here the differences between the two and a breakdown of examples of each. So we have secondary markets, and underneath that we have the broker market and the dealer market. Again, in reality, when you're selling shares, you probably don't know the difference between these two. When I'm going and executing a trade on E-Trade or some online website, I don't know the difference normally. I just go out and I buy something or I sell something. I probably don't realize that it's going to a broker or dealer market unless you've taken this class or have an understanding of how markets work. Let's break down a couple of these and talk about them. So on the broker market side, again, the largest is the New York Stock Exchange. It's recently been bought. This is the largest stock exchange. You're talking about over 2,500 companies, actually over 2,700 companies being listed on this exchange, and a large volumes. So this is a very large market. Again, as I alluded to earlier, a specialist makes these transactions in key stocks. So if somebody wants to sell a stock on the NYSE and there isn't a buyer, then that's where the specialist steps in. What's the purpose of that? Well, liquidity. So again, one of the most important pieces of an organized exchange is the ability to buy and sell at any point in time when that market is open. So they have specialists in each one of these key securities that will facilitate that transaction. So if they just can't find a buyer on the other side, then the specialist steps in and says, I will be the buyer. I will make that purchase. So there are listing policies to be listed on the NYSE. I don't recall what those are off the top of my head, but it has to do with share price, average volume. So you can't have a really low share price. You can't have a small amount of volume. These are more popular securities and larger securities. There's the Amex. It's now owned by the New York Stock Exchange, which is now owned by another company. So the American Stock Exchange used to be a very large exchange, or a decent sized exchange that was its own exchange. Now it's been gobbled up by some others. And you're seeing consolidation throughout the financial sector, where we saw it after the financial crisis, where banks were being bought up by larger banks, and you see this big consolidation. You see the same in financial markets as well. We also have what are called regional stock exchanges. These would list companies that are normally have a local appeal within that particular region. So you could buy and sell securities that are normally securities that are held within that region. The listing requirements are normally lower than they would be for the Amex or the NYSE. So the popular regional exchanges would be the Philadelphia Exchange, the Boston Exchange. Of course, there's a Midwest and Pacific Exchange as well. You don't realize that very many transactions are taking place on regional exchanges. We also have options and futures exchanges as well. These are broker markets. I'll hold off talking too much about those because we'll be covering those in much more detail in later lectures. But just know that there are exchanges to buy and sell derivative products. So I could own an option on a stock, which, remember, what's happening there is I am putting up a small amount of money to leverage a large amount of stock, and I can buy and sell that leverage to other people. So these would be options exchanges and futures exchanges. Dealer markets, again, These don't have a centralized trading floor. These normally are just market makers that are linked together by computers. That's it. This accounts for the other percentage. So about 40% of total volume in stock trades are done through these dealer exchanges or these dealer markets. And these take the form of over-the-counter markets as well. So you have inside these dealer markets the NASDAQ, and which would be the most popular. And underneath that, we have over-the-counter markets, which I'll talk about here in a second. The way that money is made in a dealer market is through what's called the bid-ask spread. So we have two pricing points. The bid price would be the price offered by the market maker to purchase a security, where the ask price is the price at which the market maker is willing to sell a given security. So we'll be talking about that this semester as we move forward in looking at stocks and looking at the bid and the ask price. There's a separation between those two. And so what happens is that provides money for the market maker to basically clip some profit. Because why would I want to be a market maker? Why would I want to be a middleman in between a buyer and the seller? I would do so at a bid and an ask price, which creates a difference between the price at which I buy and sell, so I can clip some profit in there. We'll take a look at a couple of stocks, and you can see the bid and the ask price differential between those. The largest, again, already spoke on this, would be the NASDAQ. Microsoft trades on the NASDAQ. When I think of NASDAQ, I think of more tech-heavy stocks. So tech companies tend to trade more on the NASDAQ than they do in other areas. Smaller companies tend to trade on the NASDAQ as well. So it's a very large dealer market. The next layer would be what's called over-the-counter or bulletin board stocks. These tend to be lower listing. Some people call these penny stocks, or stocks that trade in the couple dollar range tend to trade over the counter. So small companies that don't meet the listing requirements, let's say, of the NASDAQ. These are regulated. All these are regulated by the SEC, but there is a layer that isn't regulated by the SEC, and these are called pink sheets. So these are the low level stocks that most of the time are traded for pennies on the dollar. So you got shares that maybe trade for 2-3 cents. Maybe you've gotten an email about this before, or you've heard somebody talk about trading penny stocks. They tend to be very high risk, extremely volatile stocks. And you always meet somebody who said they've made thousands or hundreds of thousands of dollars in penny stocks. I've yet to meet somebody who actually showed me those transaction statements so I could verify that. But I'm sure there are a few people out there who have turned some pretty good profits in penny stocks. I would say the risk is very high. And so in the trading of pink sheet stocks, you got to realize they're not regulated by the SEC, which means they may not have the level of transparency that you would like to see in these particular securities. And liquidity can be an issue. So even though you could see a share price increase, there's no volume on the stock. So since for many of these stocks, there isn't a market maker or a specialist trading these stocks, you've got to wait till you find somebody that wants to buy the shares. So it may be hard to buy and sell these shares at times. Let's talk a bit about general market as well. So we're going to talk about some terminology. One is the bull market and one is the bear market. You may have seen the bull and the bear, or pictures of a bull and a bear fighting. This is just old terminology that talks about what's going on in the market as a whole. I'm not 100% sure where these animal analogies came from, but what I've heard years ago was the reason that we use the term bull market is because when you think of how a bull fights, it dips its head and then it pushes its head upwards. So when it sticks its horns into you, and it'll thrust upwards, and that upward head movement is an upward trend. So a bull market, think of gouging, and it's kind of nasty when you think about this, or morbid. You think of a bull sticking its horns in and then thrusting upwards, this is an upward movement. This would be favorable markets, rising prices. Consumers are purchasing. Consumer confidence is high. We're in a period of economic growth. There could be some government stimulus during this time period. Inflation and interest rates can vary during a bull or a bear market, but normally during a bull market, or at least at the top of a bull market, you tend to see higher levels of, not super high, but higher levels of inflation and normally higher interest rates. Now, a bear, on the other hand, whenever a bear fights, what do? They take their claws and they push downwards with them. I've never been in a bear fight personally, so I cannot verify this, but a bear with its claws would gouge downwards as they paw at you. And so think of it that way. When you think of a bear market, think of a pushing down or an unfavorable market. You tend to see falling security prices. Investors tend to be more pessimistic. You see the economy starting to slow down. You see the government normally in trying to pull back on spending, things like this. So bear markets and bull markets normally are best known in hindsight. That is, we can look back and say, oh, we were in a bear market, or look back and say, oh, we were in a bull market. And making the determination of when we come out of or go into a bull or bear market is sometimes easier to do in hindsight than it is to do in foresight. Let's talk a bit about globalization as well, because that is really where markets are moving to today. We're moving into a period of globalization, especially with the advent of the internet, in which we have the ability to buy and sell stocks and trade globally across the world. Many years ago, it was difficult to own international securities. Today, you can own a U.S. company that's doing business in a multitude of other countries. You see this with Coca-Cola. I think Coca-Cola today acquires somewhere around 70, maybe even 80% of their income comes outside of the United States. So even though you're buying an American company, or at least a company that's based in the US, the revenues come from all over the world. That is a globalized company. So you are purchasing an international security whether you want to or not. One of the advantages of purchasing securities that operate in international markets is this idea of diversification. So remember, we don't want to put all of our eggs in one basket. Well, how do we do that? We have eggs that are placed all over the world. So the inclusion of all these different investment vehicles tend to increase our portfolio returns while reducing our risk. So we can maximize the relationship or this risk-return trade-off. So some of the advantages of this international investing is getting into different sectors, getting into different types of stocks. So let's say, for example, I want to get into purchasing stocks that mine diamonds. Well, it's harder to find those companies in the United States, but it might be easier to find these companies listed on other exchanges or listed in other countries. So certain types of securities tend to be heavier in other countries. And so this provides some real opportunities for diversification. The other piece would be emerging markets or new growth. So the United States may be in a period where we're at an economic peak and we've maximized all the growth opportunities we can with our own consumers. Where do you look for additional emerging markets? Well, you could layer down into the U.S. market and find certain sectors that tend to be growing heavier, or you could go out and you could look at emerging countries, let's say parts of Asia or South America, and I could find countries that are growing rapidly because of new consumer bases. So there's some real opportunity there for investing in global securities. So how do we do this? How do I invest in global markets? Well, I can either do so indirectly, which is the way that I would suggest most people do it. This would be by purchasing international exchange traded funds or international mutual funds. So pooling my money together and hiring an individual who has experience in purchasing securities in that particular market, or I could directly invest by going and purchasing securities on a foreign stock exchange. The problem would be that the regulations on foreign exchanges are not the same as they are in the United States. The SEC does not regulate foreign stock exchanges, so the transparency may not be there. You may go out and buy a security on an exchange, let's say in South Africa, and that may not actually really be a stock at all. It may be a fake company that was established to steal money. So regulation's different from one country to the next. But there are people who go out and do that, and there is opportunity to make a lot of money doing that. We also have sometimes companies, foreign companies that are listed on American stock exchanges. These are called ADRs, or American Depository Receipts. So these ADRs are companies that are foreign companies that meet the regulations of the SEC and register those shares in the United States to sell on American exchanges. So these are dollar denominated, so you can buy and sell these shares in dollar amounts rather than in the foreign currency amounts necessary to buy and sell those shares. So again, what are the risks? Well, there are several risks that are involved. All the risks of investing in a stock are still there, except now we're adding on top of that, political risk. So their government policies could be quite different. So there are a lot of governments that are very unstable internationally. And let's say I go invest in some part of China, and the government just decides to shut that industry down, or to go in and just purchase the industry and keep it for themselves. These types of things happen. Foreign investment in Russia years ago, you saw those types of things happen. You still see it happen some today, as a matter of fact. So there's some instability with different governments. That is a huge risk. And then we also add into the mix currency exchange. So not only are you looking at the increase or decrease in stock prices, you also have to look at the increase or decrease in the value of that particular currency. One last thing here, and that is the trading. So stock brokers have it made. Those who are buying and selling on these stock exchanges, they work from 9:30 to 4 Eastern. Does that mean that that's when they really work? No, they work probably hours that are way worse than that, 7 a.m. to 7 p.m. But the actual exchange, so the ability to buy and sell on the exchange for at least the NASDAQ and most U.S. exchanges, is about 9:30 a.m. to 4 p.m. Eastern. Many of them do have extended hours if you want to make electronic trades. So there are some additional trades that can take place after hours, but there's normally some different rules around those. And those rules could be things like the order will not be filled unless it is executed with an identical order on the other side. So in other words, I have to sell 200 shares at a given price, and I have to find somebody who wants to buy exactly 200 shares at that given price. I can't fill a partial order or something like that.